Welcome back. Pankaj Murarka is still with us. Pankaj, when we just talk about what's happening globally, do you think Fed, the stance that they take, whether they look at QT or halt the QT, will all be particularly very important now?
Well, yes, it does become important, Pankaj. I think it's too early days. We are just about 3 or 4 days into this whole event. So I think the bigger risk now really is that now that the tail risk have actually started playing out in the US economy is that as far as this risk is concerned, the central banks have contained this. But the big question mark out there is whether it leads to a contagion or not. All of us understand that US is a highly leveraged ecosystem. In a leveraged ecosystem like US, where you have $40 trillion of debt outstanding, if you increase interest rates by 450 basis points over a period of 15 months, it's going to have repercussions. So, which is what exactly we've seen. The question now out there is that whether it remains constrained to this or we see a contagion out there. And I think the bigger risk this time around is in the private credit markets in US, because those are markets which are completely unregulated with no oversight from US Fed. And we have seen significant growth in private credit in US over the last 10 years of the QE era. So I think for the timing, I think this fallout does move Fed to move a bit slower than what was expected. Probably I think when they meet on 27th and 28th of March, instead of 50 basis points, I still think a 25 basis points rate hike is still on the table, because the fact remains that inflation still remains persistent in US. So I think this move will force the Fed to go a bit slower on that. But let's see how the whole thing plays out.
The financial turmoil that it is creating, don't you think they would be, what they comment on that would be important, because that will decide the future course then?
Absolutely, but also, as I said, the fact remains that inflation in US has been persistent and has been very sticky. The big question mark out there is, while certain part or portion of that inflation is cyclical in nature, the concern out there is some part of inflation in US are structural in nature, and that has emerged out of last 15 years of quantitative easing. So you cannot moderate structural inflation, which has emerged out of 15 years of quantitative easing or free money, in a matter of 15 months. You need to give it time. So the challenge today the Fed faces is on back of almost 15 years of quantitative easing, they kept extra loose monetary policy for a fairly long period of time post-COVID. And now they want to unwind all of that excesses in a matter of 15 months or 18 months, which cannot happen with a soft landing. If you want to unwind what you did in 15 years in a matter of 18 months, you're going to create accidents, and which is what we are seeing now. Now the question is how much, how much the Fed is capable of taking or witnessing before they change their stance. And I think they'll change their stance sooner rather than later, because they don't have ability to withstand all of this weak economic data or economic collapse for a long period of time.
Okay, Pankaj, great to have you on the show. We'll let you go on that note. Understand that you have a hard 3 p.m. cutoff is what we were told. Okay, we'll take a very quick break. But before we do that, let's also get you some closing ideas going. Kunal, on your list?
So I'll continue to go into a bit of a mixed stance over here. So the trade which I'm initiating at current levels would actually be to buy on UBL. That's a stock which I think has formed a bottom at the 1430, 1440 mark. So United Breweries is a stock which seems to have bottomed out, more or less in line with what's happening with United Spirits as well.
Right. Naresh, what about your closing ideas?
So initiated a buy on Balrampur Chini, a fresh one. It's finally some bit of a dip which was needed after that move. So at 390.95 looks like a good entry point. Would be looking to add more going forward at 410 or at 385.
Very quick break on that note. BPCL, Titan, IndusInd Bank, Bharti, ICICI Bank, L&T, Axis. They're the ones which are leading the recovery for the index as of now. Back with closing trades right here in ET now. After that breach of sub 17K, we're finally seeing a bit of a recovery coming in, but I would say it's a little bit feeble because we're unable to hold on to that 17,100 print. So let's see which way we actually head. We have a little less than half an hour still to go for trade, and frankly, anything can happen in the next 25 minutes. Gurmeet Chadda as well joins in on the show right now. Gurmeet, hi, afternoon. What do you do in this panic, Gurmeet? Just wait for the desk to settle down and sit on the sidelines?
Partially, yes. Considering the environment. So 3 times I've seen market in green today, and within half an hour, it's gone down by 100 points on the Nifty. I think also the situation warrants that if you see by take past experience. So what Fed is saying is that, or the joint statement says that they are protecting depositors, but they're not protecting investors, right? Equity and bondholders, which means that there is a rush to sell, and that's the reason you are seeing the bank indices in US and Europe correcting much more than the broader markets. Yesterday also we saw a huge run on some of the smaller banks, down 60-70%. So in a situation like this, it takes time for things to stabilize, and I think the market will also take time to figure out whether this is more systemic or just confined to a concentrated set of investors. And then there are second order impacts in terms of on the IT companies, bigger impact on startups, a slightly lesser impact on IT companies who were, let's say, dependent on some of these banks, and BFSI is a significant portion. So I think things should get stable. Doesn't look still now a systemic risk to me. I think some accident was probably waiting to happen with the way rates were being raised, and I think the dust should settle soon.
Right. Gurmeet, how do you approach this market? Just look at companies which are tried and tested, where you have, trust on numbers versus others where you believe it's a hope trade.
Yeah, so so two kinds of approaches. So because we manage client money, so one side, clients who are conservative, we don't do much. We stay on the sidelines, and sometimes, as I said, not doing anything is the best thing to do. And for clients who are a little more aggressive and are willing to take some volatility, we are looking at pockets where. So, for example, I think Indian banking system is far more robust, and any correction, I think, is an opportunity. And this is not the time we have seen 10-20% decline. It has happened maybe last 20 years, probably 15 years, you would have more than 10% corrections, right, every year. So it's not for the first time, won't be for the last time. So we are looking at some solid banks where I think the provisioning is strong. Credit growth, if you see even February data, points to a 15% credit growth. Strong on liability. I've been saying this repeatedly, that liability side would be a differentiator this year. We are also looking at some good opportunities. I think there is a clear capex revival at play. So we are looking at this housing-led capex. Also looking at some of the names in industrials and capital goods. I think cement looks very good to me, because not only there is a housing demand, there's a huge focus on infrastructure, the way the budget has come. So these are some of the pockets we are trying to derive some value.
Interesting. Gurmeet, stay with us, and thank you for those ideas for those of our investors who are willing to buy and have some amount of risk appetite. But the global jitters clearly have managed to grip D Street. We have been speaking with a whole host of experts, from Sameer Arora to Manish Tangi to Nilesh Shah and Mithul Katecha. Let's hear out what their opinion has been on the recent fall in the markets.
Broadly over time, equities will do well, and secondly, that broadly over time, if you buy on fear which is not directly associated with you, you will mostly do better than other markets where their fear might be more valid up to a point. But I don't see the connection between US banking sector and our banks at the first level. Like, the market is down less than 0.9%. If you look at it year to date, the market is down like 4-5%. And this is after absorbing a very big issue, which at the end has been handled well, which is from their point of view, the Adani issue.
Very unlikely that anytime soon we are going to ZIRP, which is zero interest rate policy in US. It's very unlikely that RBI would actually come with dollops of liquidity anytime soon, and which is why the tightness in the markets would sort of sustain very likely, even though inflation's sort of peak, as you said and alluded to, is very much behind us. It's just that the scare of it, of its return is so much that central bankers, Nikunj, would rather be circumspect, for throughout 2023 and not cut rates, or, perhaps, we'll pause on QT, but we'll certainly not do QE. And all of that doesn't augur well for equity, Nikunjan, which is why, I'm afraid that even today is meant, but I continue to say that stay out, be underweight, general equity, and be extremely cautious of small and mid cap.
In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India.
It has implications for policy going forward. As Andrew just mentioned, obviously, we've seen a significant rally in US bonds. Markets have pared back, tightening expectations to the point where now there's only a 1 in 2 chance of priced in for a Fed hike at the next FOMC meeting. And again, it seems like an overdone reaction, but now there's a real chance that the Fed will pause. So I think amidst all this volatility, the Fed is also trying to gauge the market reaction. We've had substantial weakness in European equities. Today, we've had, or will be seeing that in the futures. We've had we've had some weakness in US markets, but not significant. Bank stocks certainly came under a lot of pressure.
Gurmeet, the other thing that one is witnessing in the market, I mean, the fact that, yes, equities are the ones which are crashing, but both gold, Bitcoin are actually moving up while yields are seeing a significant amount of drop. What is it that you're making of this, move or gush to Bitcoin on one hand and gold as well?
I won't comment on crypto. Never invested, don't intend to. I think gold is usually a beneficiary. Whenever there is volatility, there is some flight to safe haven. But if you normalize it over a period of time, so maybe for hedging purpose, a small allocation can always go there. Let's say if this crisis escalates, probability is low, but if it does today, Credit Suisse, the swaps have gone up by another 40-50 basis points to almost 525 basis points. So if let's say it spreads, let's say for a very small probability, and that time probably safe haven does well. So a small allocation to gold as a hedge may work. Anyways, Indians have a lot of gold otherwise also, in terms of if you count the physical gold we have. So I'm not a great fan. I think bonds, in my view, I think because we are nearing, I think the peak rates of inflation in my view have passed. I think you will see a pause from all central banks. It could be very early. It could be, let's say, in a month or so. So I think maybe going on bonds, considering that in India probably the real yield is still positive by 1% plus, with inflation at 6.4 and let's say the 10-year bond at 7.4. I think there is still some scope there. I think maybe one can add more bonds to the portfolio for the time being, get a good carry and possible some mark-to-market gain as yields ease off. For risk, investors with slightly conservative approach.
Right. Okay, those are a couple of ideas coming your way in terms of which way investments are actually moving. Adani Enterprises also actually is seeing a bit of a recovery coming in. That stock was down, I think, in double digits at the lows of the day. It's recovered a fair amount of ground, but autos is not really seeing any recovery. M&M is still down about 2.5%. IT as well, TCS, TechM, HCL Technologies, Wipro, they're still down. There's Tata Motors also, which continues to languish. Kunal, let's first get a word in on IT. The fact that the index has fallen when it was already underperforming, has the time come now to buy IT?
Well, I would say the index was not underperforming in the last 1 or 2 months. In fact, it was more resilient, because if you look at the banking stocks, you look at the auto names, these stocks had actually started to get into a correction much earlier. It's only Infosys out of the large cap IT stocks which was correcting, but TCS, Tech Mahindra, Wipro I think we can exclude because the stock has been an exception both on the upside as well as on the downside. But most of the large cap and the mid cap IT stocks, they were actually performing pretty well end of 2022 and the first 2 months of 2023. So my sense is that the large cap should stabilize first. I would still believe that TCS as well as Infosys, they could be very good buys for someone who has a medium to long term time frame. And then once the sector starts to get into a trending mode is where you can add on to mid cap stocks from the IT pack.
Right. Okay, interesting. Naresh, let's also get in a word on, autos, like Kunal just mentioned, as to how the move has been and the selling first began in the auto names. And I can see one of the best performers, M&M, for instance, cracked quite a fair bit. What do you do here?
So Mahindra and Mahindra has given the first indication of say breakdown. So if you look at the 1200, 1230 mark was sacrosanct across the corrections over the last 6 months. And now finally we've broken that. So that indicates that the momentum is finally gone and it could retest lower levels before making the next move. So I would expect say closer to 1050 to 1080 is where I would like to buy. If that doesn't come, would wait for a recovery back about 1250. That would indicate it's a false move on the downside. But yes, the momentum has been finally broken. The stock now needs to go back about 1250 to make it interesting, or at 1050 it becomes a buy. The longer term structure, if you look at the multi-year breakout which has happened, is still pretty much in place. So 1050 to 1080 is where I would like to buy the stock.
That's the take coming in on M&M right now. Shortly, we're going to be chatting with DP Singh as well from SBI Mutual Fund, and we'll cut across to that conversation. Would be interesting to hear out the mutual fund side of the story and as to whether or not there is any amount of panic which mutual funds see that may set in after the selling in the markets of late. We will cut to that in just a short while from now. Just scouting for some other names as well, in the market. And the breadth of the market, by the way, has recovered quite smartly. And I'm just looking at the, F&O picture. It's 103 account to the reds with 91 to the greens. I mean, to think of it, for a breach of 17,000 as well earlier today, this breadth to close the day with is really not that bad at all. Bandhan Bank, though, is still down. Intellect Design is still down. ABFRL is sharply lower. It's down 4%. And Ambuja as well, lower by about 4%. But look what's happening on the GMR Infra, for instance. PVR is holding up 2.5%. Z is seeing quite a bit of price action, holding up 2.25%. United Spirits looking smart by about 2.25% again. And M&M Finance as well is also the one holding out quite smartly as we speak. Gurmeet, where in this market would you want to be contra in, if at all?
I think IT. I think and bit of pharma and specialty chemicals. I think really beaten down. Sometimes when there is the headlines are very negative, is when you get some real good bargains. Look at some of the chemical companies like Tata Chemical at 12-13 times earnings. Largest.
To apologies, Gurmeet, to just stop you there. I'm going to quickly cut across to the conversation we're currently having with DP Singh from SBI Mutual Fund.
Experience of 2008 Lehman crisis or GFC crisis has taught us that the US financial system, when it blows up, when it starts like a spark and then it really becomes an explosion there. So could this be a repeat of 2008, or this is going to be a minor spark and the fire right now is not going to be starting? Mr. Singh, thank you for joining us. Enough and more has been done about what has led to this collapse of the bank. But let's connect the India dots here. What does this mean for India?
See, there are two things, Nikunj. If we look at the earlier crisis which happened in 2008, that was a credit event. That was definitely a credit event. This is a asset liability mismatch issue. And asset liability, we are really, really surprised at how this is being done in such a manner. There's a huge, huge asset liability mismatch. When we look at India and Indian banks, I think our regulator is doing a great job, and there's no such big asset liability mismatch in Indian banks. That's number one. Number two, as far as credit is concerned, our position has improved over the period of last, I will say 9 to 12 months. It has improved much, much better. And the Indian businesses are doing so well. Most of the delinquencies which are there, people are ready to or already paid back, or they are ready to pay back. They are working towards that. So all those things are favoring our economy. I don't think there will be much impact. But yes, when an economy like US is in trouble, it has an impact everywhere. It's impacting our equity market also. But of course, equity markets was always being said that it's overvalued, blah, blah, blah. And there was a trigger required for the corrections to happen. So I think enough has happened. I think whatever needed to be happen, and we have got the fair valuations now. So I think the future is quite bright from here.
When the subprime crisis hit us, It was in 2007.
Yeah.
The term financial experts used that time was decoupling. That what is happening in US will not happen in India because the economies are decoupled. I understand that in theory we are decoupled, but when there is a leverage unwinding in the world, the decoupling becomes recoupling.
Yeah.
So isn't that a valid fear?
I think it's from recoupling to decoupling kind of thing. Earlier it was decoupling to recoupling, but when we look at the instances, what is happening in India, how our institutions are working, how the things are better, so that I think we are actually a sort of decoupled. I will not say that recoupling is happening, but see, we are a global economy now. So saying 100% as we have decoupled is impossible. So Indians also are investing outside India. What is happening in US is impacting Indian investors also, so on and so forth. And people all across the globe, they are looking at India also. So from equity side, as I said, we have our valuations come down a bit, and we are near the fair valuation. So still, there are some stocks which are still very, very costly. But a good, respectable correction has happened. So we should not be worried about it.
Indian markets frankly have given no returns from last 18 months now. The positions are light, the retail volumes are down 40-50% because no one's made money, and that's how retail investors are. They don't make money, they don't come. Do you think the silver lining in this global sell-off is that the market positioning was very light and माल नहीं है किसी के पास, to put it simply?
Yeah, वो सही है आपकी बात, पर उसमें अगर आप देखो ना, उसमें ऐसा हो रहा है कि yes, people have not put additional money. The people who have put in money earlier, they are still sitting on profits. So if there is no return in 18 months, even the money inflows are also very, very low. And SIP investors, since they are putting in long term for 5 years, 7 years, they are actually averaging. So it's good for them. So every rupee cost averaging is actually happening in a practical way. So that's what I'm saying, and I mind this is the global success story. The Indian SIP story is like a UPI. When nowhere in the world, wherever we go, whenever we go to our joint venture partner or any other geography, this SIP story could not be exploited. But we have been able to do that, and still it's growing. So I think most of the investors are not in a very, very bad situation. That's exactly what in the last 1.5 years, not a lot of bets have been taken on the market. So it's only on the numbers. I mean, optically, it's looking at people have lost a lot of money, but valuations have come down.
There's one net number of SIP, which is a heartening number, 13,000 to about 15,000, depending on the month you're looking at.
Yeah.
Feb had less months, so the number looked weak. January had more months, it looked good. Yeah. My question is that, what is the trend within SIP? Are you seeing within SIP, okay, which is that are new SIPs getting added, or existing folks are cancelling, but new investors are coming, so the net number looks good?
Yeah, you are right. The earlier numbers, some SIPs are getting stopped. Some SIPs we are getting more money. But now earlier it was like a campaign, SIP. Now it is the quality of numbers which will matter. Because if you look at it, 5 years ago also the average ticket size was in between 2,000 to 2,500. Even now with the per capita income going 3 times in last 10 years, so our SIP ticket size is still 2,500 to 3,000. So that is something where we have to reach out, because that narrative has not been given to the market. I think a lot of education is required. The ticket size has to move up from the existing, when whatever you are calling out $25 to $30, if I put it in the dollar terms, has to go to $100. So the moment we do it, and that is possible. A lot of people who are having surplus money, they are not putting the money the way they should be putting money. So I think if the ticket size is taken care of, then this number will, from the existing number of say around 1.7 billion, it's really, really possible to make it 3 billion.
Why is the SIP not going beyond T30? If I look at the concentration of the SIP data, 60 to 65% of the deposits are still coming from T25 or T30 cities. So why is that?
No, it's not that. I think we have to decode this data. Whatever we are getting from T30 is really, really SIPs. And when we look at the T30, it includes STPs also. When people put in a lot of money in liquid fund or savings fund, then they chunky amount, say 5 lakh rupees, 10 lakh rupees, 20 lakh rupees per month, they are moving to equities. So that is taking care of. And second, If you look at overall also, I mean 60% of AUM is still from the top cities. So it's in the same line. But when I look at my own number, if I look at the SBI mutual fund number, actually we are getting more than 50% on T30.
No, my follow-up question would be that if I look at the demat account penetration, it's gone to accounts and to pin codes which perhaps are even, which you have to really, find them. Somehow SIPs is not reaching every pin code in India. Maybe it is the interest, or it is the comfort, or it is the technology.
Now see, demat account opening, if we look at whatever the experts have been saying, has been done in a different manner. Different manner, one, of course, technology. Second, I mean, it was done by the fintechs in a manner where people were incentivized just to open the demat accounts. There are examples, millions of accounts have been opened where there's no activity at all. Having those demat account numbers, in fact, I don't look at demat account numbers because if I look at the data which is being shown, the 95% of the people who open demat accounts and put in money, they have burnt their fingers because they did it just for the heck of it. Second, it's so easy. Actually, things should be easier, but sometimes too easy a thing also creates a problem. Youngsters, they are just sitting on their laptop and just uploading their Aadhaar card and think the demat account is open. Okay, but whether they are using it or not, that's a different story. You have to have a disciplined approach towards SIP. You have to have put in money every month. It will be triggered. It will go from your account. Opening account, like if I take an example of my own son, he must have opened 5 demat accounts. Okay. Then why are you opening? No, somebody, I just opened. He just opened.
Did you open one with SBI also?
No, of course, that is by default it is there. That has to be there because he cannot actually trade as per when he is open. That's what exactly I'm saying. Okay. He cannot do anything. When he was student, my brother, he cannot do anything, but he just opened it. So I'm taking that as an example. I mean, his friends.
The numbers may look high, but it's not an active account.
It's absolutely inactive account.
Okay, that's the take coming in from DP Singh, the Deputy MD at SBI Mutual Fund, and quite an intriguing, interesting chat out there as well. Let's get in some BTST trades as well going. Kunal, yesterday it was sell today, sell tomorrow. What's it today?
Yeah, changing the stance a bit, expecting a relief rally for the index by tomorrow. So, two buy calls I'm suggesting. The first one is about Titan, the stock forming a base at the 2350-60 mark where it's trading right now. So, suggesting a buy with 2400 as an immediate target, stop loss at 2315. And the second would be about Canara Bank. Even this stock seems to have formed a formidable bottom for itself at this 281, 282 mark, which it hit intraday. So keep 281 as a stop loss and look out for targets of 293 on Canara Bank.
Okay, that's the take coming in. Then from Kunal, Naresh, what about your BTST ideas?
So first is a buy on Balrampur Chini. The stock has come back to a good entry point. Stop loss at 385 on a target price of 400. Second is a buy on United Spirits, a classical double bottom and a very strong move from yesterday as well as today. Good follow up, closing at the highest point of the day. A stop loss at 757 and a target price of 785 plus.
Okay, Kunal, since you are betting for a recovery tomorrow, how meaningful could it be?
So I think I would probably expect in the charts which I was showcasing earlier that if the recovery pans out, it could be as much as a 1,000-point recovery for the Bank Nifty, which may not happen immediately, but I think given the next 3 to 4 days, that could be a decent assumption which we may be working out with. And for that, we could probably keep 39,100 as a stop loss. So since we are 39,300, 400 on the Bank Nifty, the risk reward is also in favor. So it's almost 1:4, 1:5 if you're playing for a contra bounce on the index.
Yeah, 39,500 thereabouts is where we're currently at right now on the Nifty Bank. Okay, let's begin winding up for the day. And while of course it was a very different picture at the session lows where you had all sectors in the red, right now you are seeing a meaningful recovery on closing bell with chemicals, FMCG, media, metals, pharma, power, real estate as well as telecom. In fact, most of these sectors are closing in the green. Who would have thought that, right? Also a recovery in banks, autos, across the board really, cap goods, cement, while they are closing in the red. Technology, of course, has been the most beaten down one, along with financials as well as infrastructure. So Adani Enterprises, Adani Ports, M&M, TCS, TechM, ONGC, Wipro, Kotak Bank, SBI, Infosys, Tata Motors, Asian Paints, unable to recover. But on the flip side, there's been a BPCL, a Titan, L&T, Bharti, IndusInd Bank, even Reliance, which finally recovered ground and is closing in flat for the day. ICICI Bank higher by about 0.5%, and Maruti and Axis as well have played for that recovery. Not a bad day for the recovery in the market breadth as well, closing in favor of the declines but by a very slim margin, with PVR holding up 2.5% on closing, GMR, Z, M&M Finance and United Spirits all seeing a good comeback for themselves. But on that note, we're going to wind it up right here on this edition of Closing Trades. We'll see you again tomorrow morning at 8 a.m.